The debt-to-equity ratio is a financial metric that assesses the proportion of a company's financing that comes from debt compared to equity. It provides insight into the company's financial leverage and overall risk. Compared to other ratios in the leverage category, such as the debt ratio or interest coverage ratio, the debt-to-equity ratio focuses specifically on the relationship between total debt and shareholders' equity, offering a clear view of how much debt a company uses to finance its operations relative to its equity. Debt-to-equity ratio. This ratio measures the extent to which a company is financed by debt compared to equity. It is calculated by dividing the total amount of debt by the total amount of shareholders' equity. In simple terms, if a company has a lot of debt compared to equity, it means that it relies more heavily on borrowed funds rather than on funds invested by shareholders. This ratio is useful for assessing financial risk and the potential impact of economic downturns on the company's ability to meet its obligations. To calculate the debt-to-equity ratio, you first determine the company's total debt, which includes both short-term and long-term liabilities. Next, find the total shareholders' equity, which is the amount of money invested by shareholders plus retained earnings. The ratio is then calculated by dividing the total debt by the total equity. This result shows how much debt exists for each unit of equity. Example: consider a company with total debt of $400,000 and total shareholders' equity of $600,000. To find the debt-to-equity ratio, divide the total debt, $400,000, by the total equity, $600,000. This gives a ratio of 0.67. This means that for every dollar of equity, there is 67 cents of debt. A ratio of 0.67 suggests that the company uses 67 cents in debt for every dollar of equity, indicating a relatively moderate use of debt in its capital structure. Low debt-to-equity ratio. A low debt-to-equity ratio, such as 0.3 or below, indicates that a company relies more on equity than debt to finance its operations. This generally suggests lower financial risk because the company has less debt to repay and is less vulnerable to interest rate fluctuations. It often reflects a more conservative approach to financing, which can be beneficial in times of economic uncertainty. High debt-to-equity ratio. A high debt-to-equity ratio, such as 1.5 or above, signifies that a company is heavily reliant on debt compared to equity. This can be risky because it means the company has a significant amount of debt that it must service and repay. High leverage can amplify returns when the company performs well, but can also increase the risk of financial distress if earnings decline or if interest rates rise. How can companies optimize debt-to-equity ratio? Reduce debt levels. Companies can decrease their total debt by paying down existing loans or avoiding new debt, which lowers the ratio and reduces financial risk. Increase equity capital. By issuing new shares or retaining more earnings, a company can increase its equity base, thus improving the ratio. Balance debt and equity financing. Companies can aim for an optimal balance of debt and equity to support growth while managing financial risk effectively. This involves strategically using debt to leverage growth opportunities while maintaining a manageable level of financial risk. Key takeaways. The debt-to-equity ratio is a critical measure of a company's financial leverage and risk profile. It highlights the relationship between debt and equity, helping assess financial risk. A low ratio indicates lower financial risk with more reliance on equity, while a high ratio suggests higher financial leverage and potential risk. Companies can manage this ratio by reducing debt, increasing equity, or finding a balanced financing approach.